welcome back to the Better Policy Project. Before we dive into the report, please take a quick second to leave a comment with your questions or feedback, which is so important to us, and hit that subscribe button. At the Better Policy Project, our mission is to improve the effectiveness of public policy by raising economic literacy, improving analytical frameworks for policymakers, and enhancing how policy is communicated to the public.
Thank you for having me.
So for today's deep dive, our core analytical objective is to really unpack the August 2026 Global Economy Risk Assessment, which we call the GERA report. And we have a profound macroeconomic mystery to solve for you today.
Yeah, it's a massive one.
Right, because right now, the effective closure of the Strait of Hormuz has essentially removed 14 million barrels of petroleum from the daily global market. But despite that, we haven't seen this expected supply chain cascade, and consumer prices haven't completely skyrocketed. So let's establish the baseline here. How is this even possible?
Well, basic supply and demand logic suggests that a physical disruption of this magnitude should trigger, an immediate catastrophic economic contraction because industrial activity relies almost entirely on energy inputs.
Right, you can't run factories without power.
Exactly. However, we're observing a global economy that entered this geopolitical crisis equipped with some exceptionally robust shock absorbers. These mechanical mechanisms are currently artificially suppressing a global crisis, but they are entirely temporary in nature.
Yeah, and we really need to dissect exactly how those mechanical buffers are functioning. To understand this illusion of normalcy, we have to look at the data regarding our starting position before the Strait of Hormuz closure.
So the market entered this conflict with an estimated 2.5 million barrel per day structural surplus. And that physical cushion is critical to modeling the current environment, especially, when you contrast it with the 1 million barrel per day deficit we saw preceding the 2022 Russia-Ukraine war.
Oh, wow. So we actually started from a position of relative abundance this time.
We did. But beyond that initial surplus, we are observing some very aggressive mechanical workarounds. Saudi and Emirati pipelines are operating at maximum capacity right now. They're successfully bypassing the Strait of Hormuz to deliver crude directly to the Red Sea.
Okay, that makes sense.
And concurrently, governments worldwide are releasing massive volumes from their strategic petroleum reserves. And private energy firms are they're drawing down commercial inventories at just a historic pace.
Okay, let's unpack this. It's like a massive backup generator for a hospital. The city's main power grid, the Strait of Hormuz, went down, but the operating room lights haven't flickered because the backup generator kicked in instantly. But that generator only has so much diesel in the tank.
That is a great way to put it. That analogy captures the current market dynamic really well in terms of, finite capacity. And the largest component of that global backup generator is actually currently deployed in China.
Really? China's the main buffer here.
Yeah, the GCR report identifies China's deliberate demand restraint as the single most vital buffer. China possesses massive domestic crude inventories, which they've accumulated over years of strategic stockpiling.
Right, they've been hoarding oil for a while.
Exactly. So rather than entering the international market and, bidding up the price of scarce oil to secure their immediate needs, they have deliberately withdrawn. They're supplying their domestic refiners directly from their own onshore storage.
Which means they aren't competing with everyone else for the limited oil that's left on the water.
Precisely. It removes an immense source of buying pressure from the global equation.
But wait, I have to challenge the sustainability of that strategy. If China is running its vast manufacturing base at full capacity to sustain its export economy, those domestic storage tanks must be draining at just an incredible rate. They cannot simply bow out of the global market indefinitely just to suppress international prices.
No, you're right. The timeline is finite. Which brings us to how economies operate when they rely entirely on physical reserves. Japan actually provides an extraordinary empirical case study for this limitation right now.
Because Japan imports almost everything, right?
Yeah, they import the vast majority of their petroleum directly from the Gulf. Losing access to those flows through Hormuz should theoretically choke their industrial output overnight. And yet, the Japanese Manufacturing Purchasing Managers Index, their PMI, indicates continuous expansion.
Which is wild. So they are bridging this massive import shortfall by rapidly burning through their stored physical petroleum inventories. They are literally consuming their national savings to maintain factory operations.
That's exactly what's happening.
But you can't run an economy on savings forever. So what does this all mean when those global storage tanks hit empty?
Well, what's fascinating here is how the GERA report defines this eventual depletion. They introduce the concept of a two-stage shock, which is categorized in their models as Case A, and the primary analytical takeaway for you, the listener, is that this economic risk is strictly nonlinear.
Nonlinear meaning we're not looking at some slow, proportional decline in economic output as oil becomes incrementally more expensive. We're looking at a sheer cliff.
A total sheer cliff. The transition will be abrupt. Stage 1 is our current environment, right? The inventory buffered phase. Prices remain relatively stable because the physical shock absorbers are mitigating the supply deficit.
Okay, and stage 2.
Stage 2 initiates the moment those reserves deplete to critical, unavoidable minimums. The market will undergo a violent structural shift. It immediately ceases to be a pricing issue and transforms into a binding physical constraint on global economic activity.
A binding physical constraint. To be clear, that means it no longer matters if a logistics company or, say, a manufacturer is willing to pay double or triple the usual rate for fuel just to keep their business running.
All right, the money becomes irrelevant.
Because the fuel simply does not exist in the geographic location where it's required. They have no choice but to halt operations.
Exactly. The physical reality supersedes market pricing. Firms cannot obtain energy inputs regardless of their price elasticity. Production simply stops.
That is terrifying. And this looming nonlinear cliff has generated a severe divergence in how global financial institutions are attempting to model the immediate future. I mean, looking at the 2026 global growth forecasts, the International Monetary Fund predicts 3.0% growth, whereas the Bank of Canada predicts 2.8%.
And a 0.2% differential at the global macroeconomic scale represents hundreds of billions of dollars in real economic activity. It's not a rounding error.
Right, the huge gap.
Because both institutions utilize purchasing power parity weights to construct their aggregate models, this divergence really exposes opposing structural methodologies in their risk assessment.
Hold on, before we get to the methodologies, for the listener whose eyes maybe just glazed over at purchasing power parity weights, what exactly does that mean in this specific context?
Sure. So purchasing power parity, or PPP, is a macroeconomic metric used to equalize the purchasing power of different currencies by eliminating the differences in price levels between countries.
Okay, so it levels the playing field for the data.
Exactly. When both the IMF and the Bank of Canada use PPP weights, they're standardizing their measurement of global economic volume to ensure they're comparing equivalent values. The fact that their final forecasts still differ by 0.2% proves the disagreement isn't about currency valuation at all.
It's about how they actually calculate systemic risk.
Precisely. The IMF models the global economy by forecasting individual nations in isolation, and then they simply aggregate the results.
So the IMF treats the global economy like a simple addition problem. They're just adding up independent national variables without really factoring in how a crisis in one affects the other.
Right, and that is the fundamental limitation of an aggregation model. The Bank of Canada, conversely, employs a globally consistent structural model. They assess the global economy as a deeply interconnected network.
So they assume a domino effect.
Yes. Their model inherently bakes in severe, cascading negative spillovers for what they designate the implicit rest of world bloc. They assume smaller, highly trade-dependent economies are going to bear the catastrophic brunt of this physical energy constraint.
And that structural view becomes terrifying when you analyze the current maritime logistics data. Because the maritime map of the world has literally been redrawn. Petroleum flows through the Strait of Hormuz have collapsed from 20 million barrels per day down to just 4.9 million.
Which, of course, necessitates the immediate rerouting of global shipping infrastructure to avoid the choke point entirely.
And the physical reality of that rerouting is visceral. I mean, traffic around the Cape of Good Hope, navigating all the way around the southern tip of Africa, has surged to 9.4 million barrels per day.
We're talking about literal traffic jams of massive supertankers in the open ocean. It's unbelievable to picture.
It is. And these alternative routes burn thousands of tons of extra fuel. They require weeks of additional transit time and expose supply chains to just intense geopolitical vulnerability. Furthermore, the capacity is fundamentally constrained by the actual finite number of vessels on the water. It's a logistical nightmare that also impacts 20% of the entire global supply of liquefied natural gas.
Yeah. The maritime data confirms we have a fully mapped, profound negative supply shock that is actively dragging down global economic output. The sole reason we haven't entered a synchronized global recession is the presence of an opposing structural force fighting this stagflationary drag.
Here's where it gets really interesting, because the global macroeconomy is locked in an unprecedented tug-of-war. On one hand, we had the severe negative supply shock from the Hormuz disruption pulling output down. But pulling it up is a powerful positive supply shock driven entirely by artificial intelligence-related productivity growth. And this battle defines the three core scenarios outlined in the GERA report.
Exactly. Those scenarios project the possible resolutions to this macroeconomic tension. First, we have the market reference scenario. This assumes geopolitical tensions ease up, conventional shipping lanes through Hormuz reopen, and global energy buffers successfully rebuild before they deplete.
Which is the baseline hope. But then there's case A, which is the stagflationary cliff we outlined earlier. The physical buffers fail, the backup generator exhausts its diesel, and we slam into that binding physical constraint across all global supply chains.
Yeah, that's the nightmare scenario. Finally, case B represents the highly optimistic trajectory. In case B, the immense capital expenditure in artificial intelligence fundamentally raises the potential output of the global economy.
So AI basically saves the day by making everything hyper-efficient.
Right. AI integration automates knowledge work, it optimizes predictive logistics, and makes enterprises so exceptionally productive that it expands overall supply capacity faster than the energy shock can restrict it.
That's a massive heavy lift for one technology.
It is. And if we connect this to the bigger picture, the central macroeconomic uncertainty is not the initial severity of the Hormuz shock. We already recognize the scale of the disruption is massive.
Right.
The true uncertainty is the duration of this energy constraint relative to our finite physical buffers. AI productivity is actively attempting to expand our supply capacity to offset the severe inflation growth trade-off caused by the energy deficit. It is a literal race against time.
And to see how this race is playing out on the ground, we have to examine regional monetary policy, because the United States and the euro area are navigating this tug-of-war from highly divergent positions right now.
Very divergent, yes.
Starting with the U.S., the report identifies a low-higher, low-fire equilibrium. Unemployment sits between 4.3 and 4.4%. Headline consumer price index is 3.4%, with core inflation at 2.5%. However, sticky prices, which are service sector costs that resist downward adjustment, remain stubbornly high. Businesses have halted hiring, but they're retaining their current workforce.
And this low-fire dynamic indicates a controlled cooling of aggregate demand rather than some destructive recessionary crash.
Right, it's a soft landing kind of vibe.
Exactly. For the Federal Reserve, this manageable deterioration grants them the patience to just hold interest rates steady without panicking about a sudden labor market collapse. It heavily influences the approach of Federal Reserve Chair Kevin Warsh, who has shifted policy communication away from explicit forward guidance and moved toward intense data dependency and market price discovery.
Meaning the Fed is no longer telling the market exactly what it's going to do 6 months from now.
Yeah.
It is just reacting to the data as it arrives.
Yes, which forces financial markets to interpret the risks themselves rather than relying on central bank assurances.
Yeah.
The July rate decision produced a massive, highly informative divergence in the bond market. The yield curve essentially fractured in two totally different directions.
Wait, I need to interrupt here for ultimate clarity. Let's slow down and explain the mechanism of this bond market reaction. Why did short-term yields drop while long-term yields spiked? What exactly is the market telling us?
Sure. So a yield curve reflects the interest rates investors demand to lend money to the government over various timeframes. The 2-year Treasury yield dropped because short-term investors see the cooling labor data, that low-higher environment, and they anticipate near-term disinflation.
So they think rates will get cut soon.
Right. They expect the Federal Reserve will have the flexibility to lower interest rates in the immediate future to support the economy. Therefore, short-term borrowing gets cheaper.
But at the exact same time, the 30-year Treasury yield rose. Long-term investors are demanding a higher return. Why?
Because long-term investors are looking past the immediate cooling and focusing on severe structural risks. They are demanding higher term premiums, which is the extra compensation investors require to bear the risk that interest rates might not evolve as expected over a multi-decade period.
They're worried about the long-term fallout of Hormuz.
Exactly. They're pricing in the persistent supply-side inflation caused by the Hormuz shock alongside growing national deficit risks. The bond market is effectively signaling that the next 12 months might look stable, but the next decade will be characterized by extreme volatility and structural inflation.
Wow. And that tightrope walk in the U.S. contrasts sharply with the euro area. which appears incredibly fragile by comparison.
Yeah.
Europe is currently caught in a classic stagflation trap. Their second quarter economic growth was a sluggish 0.2%. Germany, which is historically the industrial engine of Europe, is only avoiding contraction because of massive government defense and infrastructure spending.
Yeah, and relying on government deficit spending to prop up economic activity presents a severe macroeconomic vulnerability. It is not organic private sector demand, and it's not genuine productivity growth.
It's artificial support.
Very much so. This dynamic introduces immense long-term fiscal risk for European sovereign debt markets, and it's masking deep underlying weakness in their economy.
And this places the European Central Bank, the ECB, in an impossible situation. Because of the Hormuz disruption and the rerouting of ships around Africa, energy import prices and upstream producer prices have spiked violently across the continent.
It is a central bank's absolute worst-case scenario. The euro area has real underlying growth near zero, and yet they face intense, unavoidable inflationary pressure from imported global energy inputs.
Because they have to buy that expensive energy regardless.
Right. And because the ECB's primary mandate is strictly price stability, the median consensus expectation is that they will actually hike the deposit facility rate from 2.25% to 2.5%.
Okay, before we analyze the impact of that, explain the deposit facility rate and how hiking it functions in an economy that's already stagnant.
So the deposit facility rate is the interest rate commercial banks receive for depositing money with the central bank overnight. When the ECB raises this rate, it ripples through the economy, making borrowing more expensive for businesses and consumers because banks would rather park their liquidity safely at the central bank than lend it out into a risky market.
So by raising this rate to 2.5%, the ECB is actively tightening financial conditions to crush inflation, but they're doing it in an economy that is barely expanding.
Exactly. It's brutal. If they do not hike rates, the surging upstream energy costs will bleed directly into consumer goods. But if they do hike, they risk completely suffocating the minimal debt-fueled growth remaining in the euro area.
That brings us to a massive puzzle for anyone listening. If Europe is suffocating under these massive upstream input costs and global shipping is burning extra fuel to travel thousands of extra miles, where is all this inflation hiding? Why haven't the prices of global consumer products instantly surged by 20% for us?
Well, to answer that, we must examine China's incredibly precarious, yet structurally critical position in the global economy right now.
Yeah, because the Q2 data paints China as a two-speed engine, and the domestic metrics are highly alarming. Overall GDP growth dropped to 4.3%. Real estate investment is an absolute free fall, down 18% year-to-date. Retail sales are expanding at an abysmal 1%.
It's very weak domestically.
But, however, their net exports, so high-tech manufacturing, semiconductors, electric vehicles, those accounted for 20% of their total Q2 GDP growth.
Right. The domestic consumer base has essentially stalled out, leaving the Chinese economy entirely reliant on external global demand to maintain its industrial output and prevent mass unemployment.
And this creates a staggering inflation anomaly. China's Producer Price Index, the PPI, which measures the cost to manufacture goods, is up 3.5%. Yet their Consumer Price Index, the CPI, is entirely flat at 0.5%. How can manufacturing costs rise sharply while consumer prices remain totally stagnant?
This anomaly is the exact mechanical transmission of the Middle East shock playing out in real time. Chinese manufacturers are paying significantly higher prices for imported commodities and energy inputs due to the maritime disruption.
Right, their costs are up.
But because domestic Chinese retail sales are crawling at just 1%, those manufacturers possess absolutely zero pricing power.
So if they attempt to raise the price of a consumer electronic device or a household appliance to cover the rising energy costs, the domestic consumer simply will not purchase it.
Exactly. Therefore, the manufacturer absorbs the 3.5% input cost increase internally. They accept shrinking profit margins just to keep factories operational. Through this mechanism, China is operating as a massive global inflation sponge.
Wow, an inflation sponge.
Yeah, they are absorbing the inflationary impact of the Hormuz shock and preventing it from transmitting to the global consumer market. But this raises an important question. What occurs when China's domestic petroleum buffers, the physical reserves they have been utilizing to avoid the international market, finally run dry?
That is the ultimate systemic risk, and it's the trigger point for the nonlinear cliff we discussed earlier. Eventually, China must re-enter the international market to replenish its petroleum stocks to keep its massive export sector functioning.
And if they are forced to initiate massive purchases while Gulf flows remain constrained by the Hormuz closure, they will instantly overwhelm whatever global reserves remain.
It immediately transitions the global economy into the catastrophic case A scenario. The inflation sponge hits its maximum capacity, the backup generator runs out of fuel, and the binding physical constraint paralyzes the entire global supply chain simultaneously.
It would be an unprecedented global stall.
So if you are wondering why your daily expenses or your grocery bill haven't spiked drastically despite a global maritime crisis, the answer is currently sitting in domestic storage tanks in China. This macroeconomic tug-of-war dictates the baseline price of everything in your financial life right now, from the price of gas at the pump to the valuation of the AI technology stocks anchoring your portfolio. We are floating on the illusion of normalcy, entirely dependent on depleted stockpiles, China's demand restraint, and the unproven promise that AI will make us productive enough to outrun a physical energy shortage.
It's a very fragile equilibrium.
I want to leave you with a final provocative thought. We recognize that AI-driven productivity is our primary macroeconomic defense against this energy-induced stagflation. It is our theoretical path to case B. But what happens to the global economy if the current artificial intelligence investment boom hits a technological plateau before those Middle East supply lines reopen?
That's the big unknown.
If AI fails to deliver the massive, immediate efficiency gains modeled in the optimistic scenarios, and our physical oil buffers deplete simultaneously, that catastrophic case scenario becomes virtually inevitable. Are we staking the stability of the entire global economy on a technological miracle arriving on a perfect schedule?
It certainly seems that way.
Once again, before you go, please take a quick second to like, leave a comment with your questions or feedback, which is so important to us, and hit that subscribe button. At the Better Policy Project, our mission is to improve the effectiveness of public policy by raising economic literacy, improving analytical frameworks for policymakers, and enhancing how policy is communicated to the public.